Hello, everyone. This is Richard Ranck with Valor Consulting and Distribution. Thanks for taking a couple minutes out of your day here to join us and talk about dividend strategies. We form Valor Consulting and Distribution to be fully aligned with advisors, and we've done that in two ways. One, we've partnered with truly best-in-class investment firms. And then secondly, we partner with some very unique service providers that can help you and your business grow as you serve your clients. Today, we've been joined by Justin Lowry with Global Beta, and Global Beta has been in the industry for a long time with Etfs and had a previous firm, and they formed Global Beta here a little over a year ago. And we've got Justin Lowry, and they've got some very unique strategies, and today we're going to focus on dividends. So Justin, thanks for joining us. And if you could just share a little bit about Global Beta and what's your investment philosophy.
Yeah, no, thanks for having me, Richard. And yeah, so Global Beta partnered with S&P back in 2017 to collaborate on building customized factor-based index strategies. And so what we did was we looked at a multitude of different factors: momentum, growth, value, quality, yield, volatility. And what we wanted to do is we wanted to build these strategies targeted in nature, but we wanted to build them through the prism of price to sales. And what I mean by that is we wanted to consider what was the output in terms of valuation of that strategy. And we wanted the valuations of each individual factor strategy to be true to its factor's characteristics, but also to keep in mind the relative valuations versus its peer groups.
Fantastic. And Justin, as we both know, there's been a lot of dividend strategies out there today. So if you could just take a moment and describe what are some of the general differences in dividend strategies out in the market today, and what makes your strategy a little bit different and unique?
Yeah, so I mean, we look at dividend strategies on two ends of the spectrum. You have your high yield oriented strategies, and then you have your sustainable growth dividend strategies on the other end. And we think that we split the difference. We're trying to deliver our shareholders a high yielding investment product, but also making sure that we're diversifying the portfolio and also incorporating companies that have sustainable dividends. So when we construct the portfolio, we do that with that in mind, and we also make sure that we incorporate the valuation metric that I was discussing previously. And by weighting the portfolio by a fundamental, in this case, we weight it by revenue, it brings down the overall valuation of the index strategy.
Fantastic. Let's shift gears a little bit and talk about the macro environment and the economy. And there's been a lot of news in the Wall Street Journal and just in the media about inflation. And obviously, inflation is front of mind for investors and advisors, and how to potentially combat that and make sure their portfolios are returning numbers above inflation. So if you could, describe how you believe your strategies would respond in an environment where we're seeing, rapidly rising inflation. And actually, I've seen numbers here that were really at an all-time high here over the last decade. So I'd love to hear your thoughts on that.
Yeah, so I'd like to share a chart with you and the viewers here. And so this chart here is exemplifying how different factors perform in and through inflationary periods. So what we're looking at is a medium-term forward-looking return of periods when the consumer price index grew year over year over 2%. And as you can see, the yield factor or dividend-oriented strategies tend to perform better than other market factors. So we're quite bullish on yield-oriented strategies. And when you understand that investors are trying to find yield across all spectrums of the market, it's important to understand that fixed income is very oversaturated, and we have the 10-year floating between 1% and 3% right now. Even junk bonds only at 4.5%. When you consider the fact that the CPI reading that came out at the end of June was a little over 5%, you have negative real returns on junk bonds right now. So We're quite bullish on the equity markets, both for obtaining yield and also total return. So, that's kind of our viewpoint right now.
That's fantastic. Yeah, I know with interest rates very low, investors I think are thinking about how can I get some yield and then also some growth. And I think equities is still a very attractive place to be, but you also want to have some good income. So I think you guys offer some excellent strategies, and thank you everyone for taking a few minutes out of your day today. And if you want to learn more about global beta ETFs, you can go to their website, which is globalbetaetfs.com. We also have some information on our website, valor-cd.com. Happy to have a discussion with you. We could set up a call with Justin and talk through how their strategies work and maybe how to incorporate those in portfolios. So with that, we'll close it up, and everyone have a great day, and thank you for your time. Thanks, Justin.
Thank you.